All right. Welcome to Let's Talk Markets Live, September 3rd, 2025. Just like that, summer's over. Kids are back in school. Football season kicks off tomorrow. I know, Eric, you're not really into the sports ball stuff.
Couldn't care less.
Yep. Thursday night, we've got the reigning Super Bowl champions, the Philadelphia Eagles, who are going to destroy the Cowboys. The smell of pumpkin spice is tickling the air. We're back for a new fall season of Let's Talk Markets Live. You know, we're often asked where we came up with the name Urvin, and it's actually an interpolation of an Icelandic word, Vinur, which means friend. And so it's fitting for the third year in a row, and we check the records. We're beginning a new season with one of Urvin's closest friends, Erik Smolinski, founder and head of Outlier Trading. Eric, welcome back, and thank you for keeping this annual tradition alive.
My pleasure. Didn't even know that it was one. That's fun. Now, the big question is, what do you think about VIX at 17?
It seems, to me, it seems shockingly low for the moment that we're in. I don't know.
Okay.
You know, what do you think?
It's funny. It's funny because if you think about the, long-term mean reversion of VIX, it still technically is elevated, but the funny part is I thought the same exact thing you did. I was like, with everything that's going on, how is it only elevated by like 2 points?
I know. That's what, I don't understand. Like the markets are they're all over the place. But I mean, part of what's keeping it down is this constant, persistent rally that, regardless of what happens, it doesn't seem anything can get in the way of. Now, like we had, the indices all fell this week, then bounced back, right? The Dow continues to slide, but there are a couple of things happening all at once. So we've got this court decision on Trump's tariffs. We've got the administration taking on the Fed. We've got what appears to be a weakening U.S. jobs market. We've got what appears to be persistent inflation, low level, but inflation that is not continuing the decline that we saw. It is the trend appears to have changed on inflation. The trend appears to be that it's sort of sticking around. So I don't know. What do you think? Like all of these things coming together, they all sound relatively bearish, and yet, we're still pretty close to all-time highs, right? Not that far off.
Well, a couple things. The first thing is I want to take this moment to reiterate my hatred for the Dow Jones Industrial Average. As soon as you said that, my entire demeanor changed because I hate
I saw your face.
The only price weighted, who uses price weighting for an index? It's worth 200 today, so now it's more important. It's crazy. Yeah. Hate that. That part aside, I'm really, really fascinated by this intersection that we find ourselves in. I don't know if you saw, but the reverse repo market essentially hit some of its lowest levels since post 2021. And so, I mean, we're obviously seeing liquidity shifts, which I actually take that as slightly bullish, less bearish, and a little bit more capital.
People don't need overnight cash. That seems like a good thing. I see like the narrative. People are like, oh my God, things are breaking. I'm like, people don't need the cash. That's good. Right?
That's that. And it's also changes in collateral requirements, right? It obviously means that things are collateralized. So yes. Not only do people have viable alternatives for the cash that otherwise is parked, but there's decent collateral out there. So yeah, I mean, I follow a lot of breadth indicators like flows into sectors. I use a lot of like sector rotation strategies depending on the time frames. And then also just using institutional sponsorship and institutional flows, right? Like our money's flowing into a bunch of really big ETFs coming out, going into the individual constituents. And I mean, it's still really strong. Like that's the most interesting thing. And I think one of the underpinning elements here is that I still am a firm believer that we are literally on the precipice of literally a world-changing technology rollout that I think the value potential from it still isn't even understood. And I think that provides such a stabilizing force against everything else that's going on in trying to understand what the potential impacts from the actual full integration of AI. I know that we say it all the time now. We just throw it in to make your earnings calls sound good. But we're actually starting to see small initial impacts in terms of headcount changes, in terms of overall profitability of especially smaller companies. Because if you think about the impact of AI, I think of it very specifically in the context of smaller companies now have a different scaling potential than they did before. And I actually think it can increase competition. But I'm curious what you think about that.
Yeah, we talked about it a lot on the show. It's something I spent a lot of time thinking about. We're actually about to, myself and a couple others, we're about to publish a piece. I'm on the editorial board of an academic journal, the Journal of AI Ethics, and we're about to publish a piece on children and youth and technology and the benefits and the risks, trying to understand the good and the bad. And with everything with AI, I kind of see it through that type of lens. There are costs, there are problems, and there are benefits, and some amazing things happening. And I will tell you, in my own usage of it, I have seen it work incredibly well when it comes to coding, and I have seen it fail miserably when it comes to things like research. It's been, I don't know where we're at in this AI cycle. I find that very hard to discern. So, NVIDIA is starting to soften. We're seeing, the CEO, I think, came out the other day to start to temper expectations about future earnings growth. You've got each of the Mag 7 spending tremendous amounts of money on this tech without, I think, knowledge of, or really a good understanding of where the earnings are going to come from that spend, from that capex, except for someone like NVIDIA, who's obviously, selling chips to everyone. But also, if you saw in NVIDIA's latest earnings report, I think their top three customers are responsible for more than half their revenue or something like that.
I've seen this metric thrown around, and I have a problem with it. A big problem with it.
Okay.
Because I think people, let me take a giant step back. What is your perception of that metric before? Is that water from a wine glass? Did I catch that right? I just got to double check.
Regular.
Okay, it's just just making sure, because I know that you're bougie, but I wanted to see
bougie. That would be
how
next
bougie
level.
are we being? Okay, got it. All right. So, what's your perception of that metric? Why do you think that that's thrown around?
I think, I see a lot of how do I put this? The economic lens that I see things through, especially in the US, is one of concentration. And to me, that dovetails quite well into the narrative that there is just this massive level of corporate concentration in the US. We've seen that in the market and in the returns that have been concentrated in just a handful of companies. And we've seen that in the corporate power that these firms exert. I don't know if you saw the Google antitrust decision that just came down. I don't know if it was yesterday, but it was unbelievably disappointing in that this judge who was statutorily obligated to take action on an illegal monopoly from Google and just said, I'm just not going to do that. The Supreme Court decisions show, I read quite a bit about this, and that judge Mehta was supposed to say that these are the things that Google has to do in order to no longer be an illegal monopoly. Like when Microsoft, when they attempted to break up Microsoft many, many years ago, and they're just like, we're not going to do any of that. We're not going to cure any of this. It's okay, because if we were to do this, it would impact other companies like Apple negatively. What? And, Google needs to be able to compete in AI. And if we break up this monopoly, they won't be able to compete. It was the craziest thing that I've seen in antitrust. And it just goes to show, it's like another piece of this, of the corporate concentration puzzle, that the US is just this giant, massive economy but it's all hyper, it's hyper concentrated into a very few giant firms that are totally anti-competitive. So that's a long way of saying that's how I saw this figure out of NVIDIA. So, I could definitely be a victim of confirmation bias here, because when I heard that, I'm like, yeah, of course that's true. It's exactly what I would think. And it's, I'm sure it's like, X and Facebook and whoever the other one would be, and yeah, of course that's what's happening. But maybe I'm wrong.
Yeah, no, I agree with the economies of scale and how that tends to lead to those kind of instances. But speaking of antitrust, I think we can all trust that your dog is having the best time of its life right now, because the acrobatics are on point. We saw flop on couch, drag across the other side, flop back down. So trust that dog is living its best life.
Oh, now, look, our dogs, they are in dog heaven. They won the dog lottery. And he was just out for a walk, and he comes storming back in. He's happy as a pig in shit right now.
Yeah, that's rad. It's good. We can see it. We can vibe off of that energy.
His name, by the way, is a little dog, and his name is Mutt, which is one of my favorite dog names that I've come up with yet.
That's a good one. I have a little dog. He's sleeping right now. His name is Thor, and
I like that.
Yeah, it's two reasons. It's always fun for me whenever we're out somewhere and I yell for Thor, and it's this 17-pound multi-poo that comes trotting over. Love that vibe. The second thing is a throwback to when I was a kid, because my grandparents had super mean German shepherds. They literally would chase my brother and I up into a tree.
Jeez.
And yeah, one of those dogs' names was Thor, and he's bitten us before. So yeah. I find the dichotomy between that Thor and this Thor to be freaking hilarious.
Perfect.
So
that's perfect. Right. Yeah.
Now, when you see that metric from NVIDIA, what do you think the downstream impact is of that kind of relationship? Because when we look at NVIDIA, it's not like they are trying to continually increase what they can sell to. They have a bunch of inventory stacked up and they're trying to get rid of it. They literally can't get inventory fast enough. So then it becomes a competition of who gets it.
Yeah.
So what are your thoughts then? Obviously, there's a natural logical progression, but just to connect the dots for people, there's a follow-on from what you're saying in your general hypothesis that it's these big companies that have made themselves front of the line and are now gaining access to these really limited resources that a lot of people are vying over.
Yeah, and so, right. So I think what you're getting at is if you're willing to buy a large amount, NVIDIA is going to prioritize you. And of course, that's going to lead to it going to the bigger companies. And if those companies were to suddenly reduce their CapEx and spending, there'd be just this giant line of smaller places that are hungry for it, and so that maybe there's not such concentration risk. And that's a totally fair point. I don't want to
just to clarify really quick, I still would call that concentration risk, though. I think nonetheless, to the broader point, I do believe that there would be demand for it. It's not concentration risk in the sense of if NVIDIA can't sell to these people, then there's nobody to sell to, as you pointed out. I think that would happen anyways. But I still think that leads to concentration risk, because if we have a limited pool of resources and we're taking 60% of it and we're giving it to 3 people, and then we're having 40% to give to everybody else, that naturally leads to a skewed playing field.
Oh, right. And that is in and of itself anti-competitive, right?
Right.
And for a company, like, look, you're judged on quarterly earnings, and it is much easier to sell to 3 firms than to 3,000. And you would see a totally different cost structure if you didn't have, that handful of firms to take down 60% of your inventory. So, I think there are all sorts of issues there. And I think you're making a great point that it is in and of itself anti-competitive, because it means that we're not creating a vibrant competitive ecosystem, right? We're continuing to concentrate power in the hands of these small but very powerful firms, which is very, again, when you want to tie it back to Wall Street and finance, it's what we do in markets as well. Like, we see massive concentration in a handful of firms, of these institutional, whether it's an investment bank or hedge fund These guys run the markets, and it's very bad for markets. It's very negative, and it leads to less resilient, less vibrant systems, right? Like a capitalist economy needs competition, and it seems like that is reducing every year. We're seeing less and less competition and more concentration in the hands of very few firms.
But those NVIDIA leap calls are going to hit. So I'm just saying, I understand this soliloquy, sad for everybody, but we can make some money. So
all right. We're going to talk, we're going to talk. Let's talk about that later on. We're going to talk about those NVIDIA leap calls, because maybe a bunch of people listening don't even know what that meant. And so at the end of this program, we're going to spend some time with Erik covering just the very basics of options and options trading.
That's right. Welcome. It's kind of like the black tar heroin of trading. It's not quite the world of like CDS, and we're not there, but we're not that far off. We're kind of close. Yeah, it's welcome to the degenerate side of the markets.
Yeah, leverage and volatility. You can't go wrong. Just right in the vein, baby.
Hell yes. Preach.
All right. Well, let's talk about a couple of the things that we started with: tariffs and the Fed. What are you seeing in the market now that like the tariffs? So the tariffs were ruled illegal. They're going to remain in place while the administration tries to fast track the appeal to the Supreme Court. Generally, that has been a winning strategy for this administration. The Supreme Court, you fast track things to them and they rule in the administration's favor. I'm sure that's because the administration has the best lawyers and everything is totally above board and constitutional, and not at all because there's deference in place to the political party in power. So, but the president said the stock market's down because the stock market needs the tariffs. They want the tariffs. Is that what do you do they need? Do they want? I mean, first of all, those are two different things. But like, does the market want those tariffs so badly?
It's kind of funny because I've learned so much in terms of like showmanship from Trump. I have learned that if you say things that are visceral enough, confidently enough, and then it's still completely wrong, and then you just say something else equally confident and visceral, you just kind of keep doing that, and you just keep it pushing. So it's kind of like, all those nerds that are worried about the Epstein files. Who even is thinking about that anymore? So I think when it comes to the tariffs, realistically, I think that the market really cares more about certainty than it cares about tariffs, yay or nay. I really think that, because I think tariffs near term, we know, would be pretty destructive, and that would be pretty problematic. But again, that also leads into this broader concentration that you're talking about, because you've also learned that if you're big enough and you just donate to the government, then you're good. That's it. Yep. You just gotta pay the VIG, and then you're good.
You'll get your exemption.
That's it. So I think that joking aside, there is a level of ingenuity to things, and big companies are super smart, man. And you know that. So it's like, even if the tariffs come on and it was as aggressive as we thought that they were going to be, blah, 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 I think you see a lot of like really near-term friction from that, but I don't think it's sustained. Because I think those companies are going to find a way to pivot. They're going to move their supply chains. They're going to do what they have to do, or they're just going to wait out Trump. Where again, that is one of the downfalls of a democracy as it's set up, is that every 4 years we go through a bipolar change in what we're all about. Flip 180, maybe sometimes 270, maybe go all the way around and back some. It's like that leads to this really
vicious swings.
Right? But that's one of the things that a lot of these companies would do is, they would say like, oh yeah, we have a 6-year roadmap and we'll have everything domestic production and we'll build some buildings and make you happy. And then it's all a pittance when you're at that size. So to summarize like that general thought, I think it's really less about tariffs on or off. I really think that the market would find a way to navigate it, and especially a lot of these companies would. I think it's more about some level of certainty, because what I can tell you is that my weekend trade, it's a specific vol trade that I play over the weekends, has not hit that much this year. And it's a short vol trade because some madness happens every single weekend where Trump said something. And then it's like, great. So this is all now not working anymore. Awesome.
Oh, no. That's funny, man. I agree with you. I mean, look, I don't know if it's just like this general sort of taco trade that's been happening, but like the tariffs have been put into place. They finally were broadly, a lot of them were in effect, and yet markets were at all-time highs, right? Like markets have continued to power through. I think you're absolutely right on this question about just certainty and predictability. Like if they're in place, the market seems pretty confident that that's okay, and that it's short-term pain, potentially long-term gain. A lot of people buy that argument. The more exemptions that you get in there, the less people buy it, I think. But from a broad, I would say, like political perspective and economic perspective, there is certainly there are aspects of this trade policy that do make a lot of sense, and that I think the market has reacted to.
Definitely. I mean, oh, sorry. Just it really resonates. One of those thoughts in terms of like domestication of some things has to happen, right? We saw what happened during COVID with chips, right? Crazy. That's a massive risk. Yeah. So I completely agree that at least starting to incentivize and drive domestication of some of these things is a net positive in the long run. As usual, always a little bit of friction in the near term.
Yeah, and like it's a shame that there have been like really just stupid things that have happened. Like the whole thing, like going after Mexico and Canada, in my mind, was something that actually set it back and slowed down what he actually wants. Which I don't know if you've heard this, but he's, I think, recently started talking about Fortress North America, and the concept of Fortress North America is that like there's this great free trade zone between U.S., Canada, and Mexico, and China is held outside of it, right? And now Mexico just recently put protections in place, tariffs on Chinese goods. They're waiting on Canada to do the same thing. Canada absolutely should do something like that, and those are the kind of things that will then bring the trade barriers between the countries down, because that's what the U.S. wants to see. That's what and like again, these are like very reasonable policy goals, very very practical and good goals. But like another part of the problem, which is I think it back to the original question of like what does this court ruling mean, is that it's hard to do this stuff through executive orders, and it's hard to do this stuff under the auspices of some emergency state that we are in. And instead, the U.S. government should start working like the U.S. government is supposed to work, which is that legislation is passed to do this and then signed by the executive branch. And that's how you get permanence to this stuff and predictability, rather than this like volatility and uncertainty.
It's funny because we've seen this story over and over and over again, where we have like big bureaucracies, because I agree with you, like that would be the optimal method. But I think you and I both also know that if it were to follow that optimal approach, I would probably be dead before it was done. Like, I think I would be dead. That's one of the issues that we face when, democracies get to where they're at. There's definitely benefits, but one of the downsides is it becomes increasingly slow, especially when you have a lot of differing opinions. And then that just becomes super challenging. So this leadership through executive order, I completely agree. I think it's become a perversion, but I also believe it's become an adaptation off of this broader system. Yeah.
Biden did the same thing, to get around the Republican Congress. Trump has a Republican Congress, but he's still doing it. Whatever. I just think it's going to get worse and worse. And the things that people are applauding today because it's their team doing it, they're going to be pretty upset when it's the other team doing it. That's why it's a shitty way to govern.
Yeah, I feel like most people have seen both sides of it at this point, that you just kind of, I feel like a lot of people have become numb to that as being part of the process, which
that's fair.
Speaking part of the process, when we talk about the domestication of stuff like chips, for example, how do you think that goes? Like, what's a reasonable rollout for that kind of thing?
Chips, it's hard. I mean, it takes massive multi-year investments. I think one of the best things that Biden did was the CHIPS Act. And I think one of the silliest criticisms of Trump coming in was, you can't, but like the CHIPS Act was totally in line with the things Trump was doing in his first term, and then he said he wanted to do in this term. It's a shame that like anything the other side did is automatically bad. It doesn't make any sense, and it's a really terrible way to see the world, and very like cynical and dark way to see the world. And instead, like, judge something on its merits. The CHIPS Act was awesome, and it was starting this process of reshoring semiconductor production, which, as you pointed out, COVID really laid bare, especially in the automotive industry, where they just could not get chips for cars. And if everyone remembers how the prices of cars started to go up, and then the price of the used car market went crazy because you couldn't get an affordable new car. And so suddenly everyone went into the used car market. And it was like this total aberration that also was a massive element of inflation during the inflationary surge. And so, to build a fab takes a long time, requires extremely specialized skill set, ton of money, and intellectual property that's held by firms like Taiwan Semiconductor, obviously in Taiwan, ASML, which is this Dutch company that has the I think the lithograph machines, and it's not easy. It's not like standing up an assembly line, right? You need these facilities with clean rooms. It just takes time. I mean, you can't do it in a year. It can't be done. It takes years and years, billions of dollars. So again, it started with Biden. It has been accelerated by Trump for sure. And I think we're going to see the fruits of that, but not for a couple more years. And even then, like, it'll be slow. I think it's going to be way slower than people anticipate.
I take the under bet on that. I think it'll be faster.
You think faster?
I do. I don't think it'll be super fast. I agree with you in terms of the general timeline, but I think that innovation is there and thriftiness is there. Like, if you don't think that you can already see some of the AI offers coming from Meta to poach people for $1 million, right?
Crazy numbers, yeah.
You start throwing those numbers to people from Taiwan Semiconductor and ASML, and all of a sudden you're going to see people sprouting up.
Yeah. I mean, it dovetails into like this question of industrial policy, right?
Yeah.
So what did you think about the idea of the government taking a piece of Intel?
It's fascinating. It really is fascinating. Yeah. And I have to be completely honest. I'm a little too ignorant to understand like the broad implications of it, because I've been around the government long enough, and I've seen plenty of companies that aren't directly owned or held by the government, but effectively are. So I have like really mixed thoughts. I can definitely see some benefits from it, but it does seem to me to start looking pretty perverted. But even at Deloitte, for example, we had two completely disparate practices. We had GPS, which was government. Everything there was government, built for government. So it's still held by Deloitte, but it's essentially completely built around this government precedent. So I can see pros and cons, and I don't really have a firmed up opinion on the overall impact and efficacy of it, but I do think it's interesting. That's one thing that I continue to actually like about what I see from just the general way that we're trying to do things, is that a lot of it, both good and bad, is non-conventional. And
agreed.
That non-conventional approach can speed things up, and it can lead to maybe favorable outcomes in some instances. In this one, I'm really not sure, though.
So very funny. The original idea to take a stake in Intel, do you know where it came from?
No idea.
Senator Bernie Sanders. This is a Bernie Sanders idea.
How long
and an
ago?
AOC. Oh, years ago, like it's part of the CHIPS Act, I believe. Now, maybe I'm speaking out of turn, but if it wasn't, if they didn't try and get it into the, I think they wanted, so part of the CHIPS Act involved large amounts of money going to semiconductor manufacturers to build plants in the US. Ultimately, I think it was done with like loans and tax credits, but Bernie and AOC wanted equity in these companies. So that's where the original idea came from. And I mean, I tend to be on, when it comes to these things, I have found myself, like the traditional argument against something like this is very straightforward. The government should not be picking winners and losers. That's not a capitalist country. That's not a capitalist economy. But like the US isn't a capitalist economy. It's very much like a crony economy and a concentrated economy. And the government's been picking winners and losers like pretty much since World War II.
Exactly.
Right? Like that's, I don't know why we're fooling ourselves any other way. So, you know, the idea that you should have one of the largest chip manufacturers in the world be a US company that is headquartered in the US and manufacturing in the US and, you know, and is solid and well capitalized, like that's a very, it's a good argument. Like there's no reason you don't want something like that. And if Intel has really screwed things up over time, and it really is, like it really is sad to see sort of the downfall of Intel. And, you know, I think that there's a good argument to be made that Intel has a lot of the infrastructure you would want in the kind of manufacturer that you're trying to incentivize to be in the US. And, you know, why not have the government own a piece of it and provide that kind of backstop and stability, just like they did with Fannie and Freddie, frankly, like to backstop the mortgage market. Like the government always has, you know, it's always backstopped the home, you know, it's backstop mortgages to make sure that the home market is stable and growing. And that's a good thing. That's been an amazing thing for the US economy. And, you know, it seems like for chips, there's a good argument to be made. I mean, I buy a lot of the populist economic arguments that where the right and the left have come together on these kinds of issues. I find it to be really crazy, you know, bedfellows, but, you know, like the idea of Bernie and Trump agreeing on stuff, it's not usual, but I think it's a really, you know, it often makes for some of the better policies coming out of the administration.
Yeah. And I think to your point earlier, if that kind of thing does go to Intel, I think that timeline's much longer.
Yeah. Fair.
I think if you give it to the dinosaurs, it's gonna move like a dinosaur.
Yeah. So let's what do you think of the Fed? Let's talk about the Fed. You know, and Fed independence.
Funny enough, Fed independence aside, I think that reverse repo metric is fascinating because it actually starts to show us a little bit of a pivot away from really the Fed having this overly controlling say in things. If we're starting to yield hunt in things like bills and whatnot, we're essentially saying, we'll go somewhere else. We'll even go to the private reverse repo market equivalent. So like, I think the Fed has just become such a sensationalized talking point. And it's the same thing that we've known forever, right? It's the Fed can do things to influence the short term, but the bond market is going to drive what's happening. And it's done that forever. And we saw the uptake of the bond vigilantes come back up a little bit recently, which was a really fun experience, actually, because for people like me, there hasn't been a lot of instances throughout history where, you know, that the bond vigilantes really start getting super involved and being able to see a piece of that happen live. But I think the it's just a sensationalized political thing now. I really, I think you saw that with with the latest decision in the rate cut. I think as soon as you see two Fed members essentially say, we think we should cut, and they go out publicly and say that to me is showing that's showing some pretty significant dissent, because I say this to my audience all the time when we talk about this. It's like, I'm sure that when you see the Fed come out and vote and it's, all in favor, none opposed, that it's not really all in favor, none opposed. I'm sure in that conversation, some of them said like, you're an idiot, John, we should do this instead. Right. And then they're like, but we'll all agree, and then we'll, have a united front. The fact that two of them publicly dissented and wanted it to be seen as not agreeing with this decision, that to me is super telling. Yeah. So
everything is political now. Like,
right. I think that's it. I think noise.
And so the market's pricing in a near certainty, 95%, I just checked on CME Fed Watch, of a 25 basis point cut in 2 weeks. Far be it from me to like second guess that certainty in the market, but it seems like it's still dependent on these inflation numbers, and if they remain sticky and slightly elevated, it still seems especially like you've got the labor market softening now, which bodes for argues for a cut, but you've got inflation sticking around. I don't know. What do you
think? Transitory.
It's the pulse was transitory, but like we landed at a much higher level than anyone I think wants to be at. All right. For longtime viewers of the program, you would know that this is consistent. As we mentioned, this is the third year talking with Erik, and in the first year we had a whole debate over whether the inflation was transitory or not. And I was team transitory, and Erik likes to point that out every chance he gets.
Super transitory.
I mean, look, most of it was, but it's still here, right? It's here at a lower level. It's here at like a sub 3% level, but it's still here, and it's still higher than the Fed would ordinarily like it to be, and where they would target for it to be. And to enter a rate cut cycle with higher inflation like that, I don't know. It doesn't seem like such a certainty to me, but maybe again, everything is political, and Powell knows that he's got to do something, even just 25 basis point cut.
The cool part is, and this is honestly my favorite part is being a trader, is all of this stuff is tradable. So as I sit there and I see this clear political discourse occurring between the Fed and the current administration, there's a trade there, because small caps were just bound forever. They literally years. Small caps have been underperforming and bound. And then as soon as this glimpse of the first series of rate cuts, you saw small caps skyrocket. And then as soon as it happened again, the same exact pattern occurs. Small caps become such a tradable vehicle around the broader discussion of rate cuts. Whether or not it's going to happen, when it's going to happen, you can always see it happening in small caps. And small caps as of late have actually been outperforming, not in terms of total percentages, but in terms of time-bound percent moves than the S&P, for example. So you can see like the recent 10 days, 5 days that small caps has really started moving. Now pulling back for sure, and everything's pulling back right now a little bit, and that's the nature of the beast. But I think regardless of how the conversation goes between those two entities, when the inevitable rate cut does come, we're already seeing a departure again from the Fed tool. And I want to keep that in context. There's still trillions throwing through it, right? It's not like it's, siphoned down to zero. Yeah. But people are seeking alternatives, which is in and of itself pretty telling. So I I always find myself interested in the gamesmanship behind it. But from a trader's lens, all you have to do is figure out, how does this flow through into price movement or volatility movement, and go make some money on it.
All right. Well, let's start talking about that. Let's take a bit here at the end of this episode. It's been a fascinating chat. I did want to switch gears. You know, the kids are going back to school, and I thought maybe those listening in would like to learn a bit about options. You know, on your stream, you're talking to people that know about options. They want to trade them. Here, we generally focus on equities. And so I thought it would be worthwhile to take some time and talk about some basics of options trading for our viewers who may not be entirely familiar with the subject. Can you give like just a very basic overview of what an option is, how's it differ from owning a stock, and you know what the very simple, like the just what is it about an options contract? What are the metrics and the parameters that make it so different from stocks, and how does that affect trading and position size and all that?
Definitely. So the way to think about owning an equity is it's a very straightforward relationship. You are essentially giving your money to a company for partial ownership of that company, and then you essentially have that involvement, and you profit very simply in holding an equity. You profit from things like yield. Do you get a dividend? Or price movement. And in price movement, I count, stock buybacks and stuff like that in there, because that influences price movement. That's another way to pay shareholders. So the world of holding equities is common, really well understood. When we step one frame away, we enter the world of what we call derivatives. And the easiest way to explain derivatives is they are products whose value is derived from something else. So a quasi example that I like to use, it's not perfect, but I think it's relatable to most people. It's like the deed to a house. If you think of the deed to a house, the deed itself is just a piece of paper. It means nothing. It's literally just paper. However, that deed grants certain rights, privileges in a transaction. So if I'm buying a house, I give money and I get that deed. I now have the rights to that house. The way to think about derivatives is in a similar way. They set up specific relationships related to an underlying asset. So the way to think about derivatives in general for retail traders, we have like two buckets: options and futures. There's technically more than that. There's swaps and stuff like that, but that's more on the institutional side that retail traders pretty much aren't going to touch much of. So in the options world, we have, you used the term before, we have these contracts between two parties that pertain to an underlying asset. Pretty much it. So in the options world, we have two kinds: calls and puts. The way that those behave vary based on how the underlying moves. And the main thing to keep in mind with options compared to equities is that we refer to options as strategic investments. What this means is I can set up very specific risk reward profiles based on what I think is going to happen in the underlying. That is a gift and a curse. It's a gift because it gives you way more control over the risk reward profile, but it's a curse because you have to have a more informed opinion on whatever you're trading, because you introduce other price impacting factors. So back to the beginning, if you hold stock, your P&L is impacted by direction. Does this thing go up and down, or are you getting a yield? As soon as you enter the world of options, your P&L is now impacted by other factors. We have things like price still, that's measured through a Greek called delta. When you hear the term Greeks, that's just the way that we measure changes in options, because there's multiple inputs. So there's still price impact, but then there's also things like time. The way to think about time is if you and I are making an agreement between one another for any sort of contract, if the agreement is short or long, which one is going to be more valuable? The longer one, because it's a longer time frame. That contract is longer standing. There's more things going on in it. So time is another one. Volatility is another one. So in the stock world, most people are used to things like realized vol or historic vol. That just means how much did something move in the past? And traders use common vol metrics all the time. ADR, average daily range, ATR, average true range, or opening range breakouts. All of those are essentially volatility metrics. How much does this thing move? But in the options markets, we're very interested in a metric called implied volatility, which is the forward projection of expected volatility. So you're now trading a future expectation, which is very different. If you think about stocks, it's not that different in the context of discounting future cash flows. And this is where we think a stock is going to earn this much going forward. Then we go through an earnings release, and then Jensen comes out and guides down those expectations. That's the implied earnings coming down. Well, it's kind of the same thing with volatility. If we think something's going to move a lot and then it comes down, then implied volatility can contract and expand. Very similar to that. So to summarize all of that very quick crash course on options is that they do add complexity, but they do add a lot of flexibility. Some of the common uses for options are to gain leverage. They're to trade non-delta profit mechanisms. So non-delta being those other things we're talking about, time, volatility. People use them for hedging. So you can set up these really, really interesting individual trades and then also portfolio level trades, completely different way than equities.
So I think that's it's really, that was a great overview. What about, I see a lot of interest in generating income using options. Can you talk a bit about that?
I hate that. I hate that concept with a fiery passion.
Okay, good. Warn them off. Tell them why.
The reason why I hate that concept with a fiery passion is because I think it sets most traders up for failure. Options are no more suited for income generation than stock trading. It's the same thing. If I buy stock, it goes up, I sell some of it, I pull some of it out, there's my income. There is this massive illusion with options because of the way that we can open the contracts. You can open an options contract by buying it or selling it. Think of it like equities. You can buy to hold a stock, or you can sell a stock short. Very similar in options, and you can do that with both calls and puts. So people will often misconstrue selling options as income. The reason why it gets misconstrued is if I sell an option, I collect money up front, but just because I collected money up front doesn't mean I get to keep it. It's tied
free money.
It's tied to an open trade. So I would say that that's a lot of things that you'll see fake gurus, and you'll see people that are just trying to essentially trick people. Like, that's what it is. They're trying to make it seem better than it is, because think of the game theory behind that. Who wouldn't want some sort of easy, consistent income, right? Of course, that sounds good. But anytime that something seems really desirable like that, you always have to question why. Why would this be the case? So it's really a marketing tool. Options as income, in my opinion. It's no different in terms of income generation than other things. Now, you absolutely can trade options and generate income, of course, just like you can with stock, just like you can with futures. But people think that this relationship of selling to open is your income, and it's completely broken. Newsflash. If you want to be able to trade for a living, regardless of what asset classes you choose or choose not to trade, the game is not, let me make money that I need for this month. That's not how this works. If you want this thing to be robust, you're going to save up a year, 2 years, 3 years of expected expenses. And then the money that I make this month is just plussing back up my 3-year buffer. And it's because everybody that does this seriously, we recognize stuff happens. You might get COVID. And you might not be able to trade for a little bit. What happens? There goes your income for that month because you're living spoon to mouth, expecting it to work. And that's all part of the options for income facade, as it were.
Okay, let's go a bit back to basics. So like, what does it mean for an options to be in the money versus out of the money? And how does assignment and exercise work?
Super simple. The way to think about moneyness, that's what we call it, is in an options contract, there are different components. We have things like an expiration, because all options expire. One of those other components is what we refer to as a strike price, the strike. The way to think about the strike is, again, going back to the deed of a house example. You and I agree on a price for that house. That's the strike price. You and I now are in agreement. And it's almost like wholesaling a house as well. That might even be a better example, probably less people familiar with that. But it's essentially a price that we're agreeing to. We're saying this is the price that this asset, this house is worth, or the price that we're going to transact at. So in options, there's a strike price. And that's simply the contract that you're choosing to transact at. Now, the relationship of that strike price to the underlying price or spot price is how we determine moneyness. And it differs for calls and puts. The way to think about the value of an option is that there's really two components. We have intrinsic value and extrinsic value. Inside, intrinsic value is simply how far in the money that option is. Extrinsic value are things like time, volatility, yield, all of that stuff is kind of baked into the extrinsic value of an option. So without going super deep into the specifics on calls versus puts and stuff, normally when I do stuff like that, I actually like to draw it out. I am a Neanderthal, so being able to see visual things helps me. But the main thing for people new to the world
were surprisingly intelligent and well adapted to the environment.
Yeah, relatively.
They get such a bad rap.
They kind of do, but they're not here, so they don't get to defend themselves. So just know when we talk about moneyness, that just means the relationship between the strike price and the underlying price, which one's higher than the other or lower than the other. Then when it comes to the world of settlement, this is how we close an options contract. It's a little different than stock. So if you buy a stock, you buy to open. And if you want to close your stock position, you sell to close. You just balance out the trade. You buy 100, you sell 100, you're now flat. You're out of that position. So with options, that is one method to settle your position. You can simply trade the contract. So if I buy a contract from somebody and it appreciates in value and I want to get rid of it, I can then just sell it to the market. That's really the most common way to settle an options contract, is to just trade back and forth the value of the contract. The other ways are things through exercise and assignment. Mm-hmm. Now, the way to think about the difference between exercise and assignment, it's essentially the same market closed. It's the same transaction, but it depends on if you bought the option to open or sold the option to open. If you buy to open, you have a choice because you bought the right to that option. So those people get to choose if they want to exercise their option. The people on the other side that sold to open, they have an obligation to deliver the opposite of the trade that they took. And when I'm talking in this way, it's because the way that calls and puts work are different. So at a high level, the buyer has a choice on how they want to settle, whether via trading the contract or by exercise. Exercising involves the movement of the actual underlying equity. So if I choose to exercise a call, it means I'm going to buy shares from somebody at a certain price. If I choose to exercise a put, it means I'm going to sell my shares to somebody. That's how people hedge a lot of times with options, is by setting a floor. Now, the most important thing to take away from this is that the overwhelming majority of instances do not transact through exercise. And it's because it's generally inefficient for a lot of reasons outside the scope of this video. But more often than not, people are just going to transact the option contract itself.
Okay. Makes sense. I think this has been great. Super interesting, Erik. Really appreciate you taking the time and even like going back to basics. I hope some people learned something from all of this. And I'd like to do this, on a regular basis. Maybe next time you can bring some visuals up and we can get a little deeper into, what's a call, what is a put, and then what are some more interesting trading strategies or ways to position yourselves in the options market, like covered calls and cash secured puts and other types of go ahead.
One thing I want to add really quick about options is that for just about everybody, it's super overwhelming the first time you hear it. And it's because you're literally just hearing a lot of words that you don't know. Think of anything else, right? If I go to a different country and I try to have a conversation with locals, I'm overwhelmed because they're speaking words that I don't know. But it's just like learning a language. You can learn it. And the thing to keep in mind is like you literally just need an elementary level understanding of math. It's not crazy. It's just a high threshold to get over all these stupid terms that we use in the industry. And it's literally just because it creates a barrier to entry. Like there's only good reason to do it. So if you have any interest in options, but you're like, man, I don't know if I can learn this, you literally can. You absolutely can. It's just a matter of learning language first, and then the rest of it will start to learn. Just don't be overwhelmed by it. It's just new words. Nobody knows it at the first shot.
For sure. And if you really do want to get deeper into it, Erik's channels are a great place to do that. Outlier Trading on YouTube and all social media. So, check that out. Check out his videos. You do a ton of education. Really appreciate that.
Yeah, on that, every Friday at 5 p.m. Pacific time, I do a beginner live stream. So it's literally something just like this. The reason why I do that is because I remember being a beginner and I remember hearing somebody say, oh, I got to flatten my deltas. And you're like, sick, bro.
What
does that mean? Yeah. And then you realize, like, once you hear the terms that literally it's super simple, but it's just words.
Yes. And there's just so much jargon that especially Wall Street uses to couch what they do in complexity and sophistication. And it's actually basic arithmetic and learning a language, as you put it, Erik.
That's exactly right.
Yeah. So again, thanks for coming on. Always a fun and interesting and insightful conversation. Thanks everyone for tuning in. Really appreciate it. As always, like and subscribe on our various channels. We'll be back next week, continuing to talk markets with Dennis Dick and George Kailas from Prospero AI. We've got a great question, but it didn't really fit in. So our coats, I'm sorry. I'd love to answer this question and give it the time that it needs. And we're going to have a podcast episode later this month. I believe on September 23rd. We've got one set up with the CEO of a publicly traded company, BTCS, Charles Allen, and he has been in the fight against short selling. His public company is issuing a blockchain-based dividend, and we're going to talk about all these issues around abusive short selling and price discovery then. So I don't mean to kick it off and plug the other episode, but really, join us in a couple of weeks, September 23rd.
That's a great question.
Yeah, it is, and one that deserves a full episode to talk about, and that's what we have planned. So join us then as well. And as always, everyone, really appreciate you tuning in and spending some time with us. And hopefully you learned something. And I hope you have a great day and the rest of your week. So thanks.
You guys,
we will talk soon.